Hello, in this presentation we will compare QuickBooks Online versus QuickBooks Desktop. Hello, in this presentation we will record advanced customer payments within QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. Here we are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're going to record an advanced customer payment. In order to think about that, we're going to select this drop-down item here and think about the customer section over here in the normal process and what happens with an advanced payment, or we can call it a deposit on a guitar in this case. Normally what happens is we're going to create an invoice and then we receive payment, and then we put that payment in the bank and record the bank deposit. Or we have payment at the same time as the work is done and use a sales receipt. In essence, we can think of the customer bringing the guitar from the store to the front desk and making the payment at that point in time. Now, in this case, what we're going to say is the customer went in and said they want this particular guitar, but possibly it's in a different color or something such as that, and therefore we have to order the guitar. And to do that, we're going to get a deposit. We're going to get a payment from the customer before we do the work, before we earn the money. Typically, in most accounting textbooks, that would mean we'd have unearned revenue, meaning we'd have to increase the cash and then increase some other account. Usually would be revenue if we had earned it, but we have not because we haven't given the guitar yet. And therefore, we should increase a liability called unearned revenue. In this case, we're actually going to create a negative receivable, and that's kind of like one of the simplest ways to deal with this and be able to connect everything else. So logistically it works well, although it's not exactly generally accepted accounting principles, and we'll have to make an adjustment at the year end if there's still one outstanding, as we will see. So let's see what this process will look like. What we're going to do is we're going to not have the invoice first or a sales receipt and go right directly to receiving payment. We're getting a deposit from a customer. We're getting money for work that has not yet been done. We're getting money, $300 for guitar we will order and create a sales invoice for in the future. So we're going to say there's going to be a sales receipt, and remember what that means is basically we got money, so it's going to go into undeposited funds here. So we're not going to put any email address. We're going to say that the date will be 02/21/21, February 21st, 2021. We are working in the month of February, year of 2021. Payment method, we're just going to say is going to be cash. No reference number. It's going to go into undeposited funds as opposed to the checking account because we have it in the store, and then we will take those deposits, group them together, and deposit them into the bank at the end of the day. If you're directly depositing into the bank, then you can of course choose the checking account here and skip that last step, but we do want to group it in the bank in the same format as they will be on the bank statements in our QuickBooks system. That's what this undeposited funds helps us do. Then we're going to say the amount received. We can't just check anything off. Note that if we had some outstanding invoices, we typically would check off the outstanding invoice and say, hey, that $300 was applied to this invoice that we made in the past, and tie those things out. But we don't have an outstanding invoice because we are getting the deposit before the invoice. Unusual transaction. And I should say it's unusual just really in most types of businesses. So some types of businesses, this happens all the time. If we sell newspapers or any kind of subscription service, then we typically get paid before we provide the service. Meaning, if we have newspapers, we probably get a year's subscription to the newspaper or something like that before we provide the newspaper, and therefore it should be unearned until we provide the newspaper. But for many businesses, if you're talking about a law firm or a CPA firm or bookkeeping firm, we do the work before or at the same time as we receive payment. So that's why it's a bit unusual here. In this case, it's unusual for this type of business because we typically get the money at the same time or after we do the work or provide the guitar. In this case, we're getting money before we provide the work or the guitar. So we're going to say that it's $300 here. And that's all we're going to have here. Now, again, there's nothing we can check off to down here. So what's going to happen to this transaction is we're going to have the received payment is going to be basically decreasing the receivable. That's what the received payment does. And it puts the other side into some account, typically undeposited funds or the checking account, whatever we select here. So that's what this form always does. But the funny thing is that it's decreasing the receivable when there's no receivable to decrease that would have been created by the invoice. That's the funny thing that's going to happen here. It's going to create a negative receivable for this particular client, and that's going to be the unusual circumstance. By the way, the client here, I thought we had put the client up top, is going to be string music. And this is going to be a new client, so oh no, it's not. String music, here it is. So string music, it says string music payment does not have an open invoice to go with. So we got the $300 payment for string music and no open invoice. And we're going to say that's okay. It's going to create that negative receivable. And we'll see that looks funny, but it kind of works logistically. So this can be used in practice. So we're going to say save and new. And then let's see what happens. So we're going to close this out. We're going to go back to the reports left side. We're going to go to the balance sheet. We're going to change the dates to 02/01/21 to 02/21/21. That's the February 1st, 2021 to February 28th, 2021, and run that report. In the accounts receivable account, then, if we select the accounts receivable account, we will see the activity within the accounts receivable, and we see this $300 here, and it's a negative 300. The funny thing is it doesn't tie out to anything else. We don't see any invoice that ties this thing out to. We'll take another look at that in the customer detail as well. Before we do though, let's go back. We're going to go back to our summary and see what the other side is, which will be undeposited funds. So we didn't put it in the checking account even though we got payment, we got cash. We put it in the undeposited funds until we go to the bank. There's going to be the 300 here. If we select that item, that will go back to this receive payment item. So now we're going to check out the customer payment. So we're going to go to the customer detail, I should say. Go back to the reports and really see what we're doing with this receivable, this negative receivable that's happening here. So if we go to the customer balance detail, we're going to see all of the accounts receivable. It should add up to the accounts receivable balance that we had on the balance sheet, but it's going to break out the information by customer in this case. And we can see this all looks normal. Jones owes us $399. We have the music store stuff, the detail for the 2 invoices owed to us here. We have Tom's guitar or Smith guitars owing us here, but then we have the string music and we have this negative item. So that shouldn't be happening really. That means that we have a negative receivable, which really means that people don't owe us money, we owe them money. And that should be more of a liability. It should be unearned revenue or some type of liability account. But it works well in the receivable because once it creates this customer balance detail that we can organize all this in. And then once we create the invoice, it'll match up nicely in this report and just tie this thing out. And that'll show that it ties out. So logistically it works, but from a financial general accepted accounting standpoint, as of this point in time, this balance isn't quite right. It should be increased by $300. And the liability should be increased by $300 rather than having us netting this $300 out and decreasing the receivable. Now, once we get the invoice done, it'll be okay because this will just net out and we won't have a problem anymore. But if the cutoff date, we have to make financial statements by the end of the year, then, and we have this 300, as we'll see, maybe not this 300, but we'll see a similar situation, then we should do a journal entry, an adjusting journal entry to increase the receivable by this negative amount, and then put the correct amount shown as a liability for what we owe, because really we owe this 300 back, or we owe the guitar that we will give in the future once we complete the transaction. Hello, in this presentation we will record an advance customer payment within QuickBooks Pro 2018. If you've been working along with us, we will be continuing with the Get Great Guitars problem. If you have the backup, you could restore that backup at this point with a file and restore the backup. If not, that is okay. We will be recording an advance payment, a payment that has been received before the invoice or the goods have been shipped, that being a guitar in this case. In order to work this problem, we currently have the home page open. To open the home page, go to Company and Home Page. We also have the Open Items list open. That's under View and Open Window List. Only window open is the home page at this time. Our scenario is here that we have a customer that would like a particular guitar. They've requested to hold that guitar for them. In order to do that, we have requested a deposit on that guitar. So we're going to hold on to this piece of merchandise and therefore give that piece of merchandise in the future. So we're not going to create an invoice because we have not yet sold it, but we have received money, so we have to record the fact that we've received the money. So this is a circumstance in which it's a little bit backwards when we look at our flowchart, meaning typically we have an invoice and then we collect the money, we get the check in the mail. In this case, we got the money before we create the invoice. So what we're going to do is we're going to create that invoice and we're going to create the receipt payment, depositing or recording the fact that we have that $300, in this case we're getting $300, for the guitar that we will sell in the future. Then once we sell the guitar, we're going to create the invoice and we have to be able to apply that credit to what has been sold at that point in time. So this is to record a deposit from a customer before the work has been done. In accordance to the revenue recognition principle, we can't record the revenue. Therefore, we cannot create the invoice yet because we have not yet earned the deposit we are receiving. Instead, we're going to record this receive deposit or receive payments, and we'll see what the transaction is and look at the financial statements and what's being recorded and how we would then deal with that in the future. So we're going to go to receive payments. We have received a payment for a customer in order to hold on to a particular guitar. That customer is, if we select the drop down, we could find the customer. It's going to be string music, very bottom. I'm going to start typing it in and that will give us the item. So we're going to say tab. We're going to receive 300. The date's going to be the 21st. So I'm just going to hit the up arrow or the up plus button to get to the 21st. It's going to be cash. We're going to say cash here. And then we're not going to have a reference number. And that will be it. So once we have this customer payment, we're going to record this note that it's not being applied to any particular invoice. If there were an invoice that String Guitar had out in place, we would have to make sure that we do not apply to that invoice if it's a deposit on another guitar, an advance payment that we have. The fact that it's not being recorded to another invoice means that when we create an invoice for this customer, it will then be available to apply that credit, this prepayment, to the invoice that is created. What's going to be the transaction when we record this? The fact that it's a customer payment means that it's going to be increasing the payments. You would think cash, but typically QuickBooks is going to put it into that undeposited funds account until we put it into the bank, until we go to the bank and record the deposit side. So it will be increasing undeposited funds. The other side of it, you would think, would be decreasing a particular person's receivable, typically when we have a customer payment. But we don't have any invoice here. What it's going to create then is a negative receivable for string music. That is odd. That's not normal accrual accounting, but it works well within QuickBooks, meaning normal accrual accounting would say we would need a liability. We would need to credit the liability and say that we owe something in the future. That something in this case being the delivery of the guitar. If we don't give that, we should be giving the 300 back. So we owe something in the future. In this case, we're going to have a negative asset. Why? Because that makes it easy for us to track the asset in accordance to the customer, and when we then create the invoice to tie those things out. So let's take a look at what that will look like. We're going to say save and close. And it's going to say we're going to create a credit. We're going to say that is what we want. Okay. And look at the reports that we have. We're going to say reports drop down. We're going to go to company and financial. Let's go down to the balance sheet and see what we have in the balance sheet. We're going to change the dates So we're going to go to Customize Reports, and the dates will be from 01/01/21. We will be working in the future to 12/31/21. We are working in the future. By changing the date ranges here, although there's only one date here, once we drill down on the data, we won't have to change the data when we look at basically the general ledger or the transaction reports. So we're going to go to the accounts receivable first. Here is the receivable. If we double click on that amount, we see that 300 here. The split, the other accounts going to undeposited. Here's the 300 in the receivable, decrease in the receivable. It's in the receivable, although it's not being applied to any particular invoice, as typically the payments will be. As we can see with some of the payments up top, where we have the 525 here, the payment being related to this invoice, the 430 here being related to this 430.50 here. Here we've got the 300 payment not related to any 300 invoice, but decrease in the receivable. If we close this back out, and we then go to the undeposited funds, that's going to be the cash account, undeposited funds. Double clicking on that, that should be the other side of the transaction. Scrolling down, we see that 300 there. Double clicking on that, we see our customer payment. Closing this back out, we'll take a look at one more place where this will be, the customer report, the reports by customer. Go into reports up top, go into customer and receivables, scrolling down to customer balance detail, and going all the way to the bottom where we have the string music, we see this 300, and it's a negative receivable. Again, that shouldn't be the case. We shouldn't have a negative receivable. However, the negative receivable helps us when we tie out the invoice to the particular customer. So we don't have to be jumping from the liability account to the receivable account. If we keep it all in the receivable accounts, then QuickBooks has a nice, easy way to tie out the deposit to the later invoice that we will then create. If, however, we were reporting this in terms of the financial statements, we would need to take this out of the receivable, meaning increase the receivable by that 300 and record a liability for the fact that we have this prepayment and therefore owe something in the future. So be aware of that when you go through this process. This process works really good within QuickBooks to tie everything together, but it's not exactly generally accepted accounting principles. If we were to report under generally accepted accounting principles, under normal accrual accounting, we would have to increase the receivable by this, not have a negative receivable, increase it by 300, and record the related liability for something that we owe in the future.